Have you ever felt that sinking feeling when you see a stock or crypto token exploding on social media, everyone posting their gains, and you think maybe this is finally my chance? You hesitate, you doubt, but then you see another 50% spike and think I can't miss this again. So you buy in. For a brief moment, you feel like a genius as your position shows green. Then, almost like it was waiting for your purchase, the price starts collapsing. The community that was cheering suddenly goes quiet. The influencers move on to the next opportunity, and you're left holding an asset worth a fraction of what you paid, wondering how you got it so wrong. You probably blamed yourself. You thought you were greedy, that you didn't understand the market, that you should have known better. But what if I told you that your loss wasn't a mistake or bad timing? What if the entire sequence, the hype, the surge, your entry point, and the collapse was engineered exactly this way? What if you weren't an investor who made a bad call, but a participant in one of the oldest, most profitable wealth extraction mechanisms in financial history? My name is Pig, and I spend way too much time studying how systems of power actually operate, the hidden mechanisms that transfer wealth from many to few, the psychological techniques that make exploitation feel voluntary, and the legal frameworks that make systematic fraud appear as market. Volatility. The pump and dump isn't just an occasional scam affecting unlucky people. It's an industrial-scale extraction mechanism that operates with mathematical precision, protected by regulatory gaps, enabled by modern technology, and psychologically engineered to make victims blame themselves instead of recognizing they were systematically targeted. If you want to understand how billions of dollars get transferred from retail investors to coordinated operators every year while perpetrators face minimal consequences, make sure to hit that subscribe button. Because what I'm about to show you reveals a blueprint that gets recycled across every market, every asset class, and every generation of investors who think this time is different. Here's what they tell you about pump and dump schemes and modern trading opportunities. According to the Securities and Exchange Commission, a pump and dump occurs when fraudsters artificially inflate asset prices through false statements, then sell their shares before the truth emerges and prices collapse. The textbook explanation presents this as illegal activity by obvious criminals, boiler room operators with thick accents, cold-calling grandmothers, or shady penny stock promoters operating from strip mall offices. The official narrative suggests that modern regulations, sophisticated surveillance systems, and investor education have largely eliminated this problem. When pump and dumps do occur, we're told they're isolated incidents involving obscure assets that only affect unsophisticated investors who should have known better. Financial educators explain that these schemes are easy to spot, look for low-volume stocks, companies with questionable business models, and overly aggressive promotional campaigns. Economists will tell you that speculation adds liquidity and helps markets find true asset values. Social media platforms claim they're neutral communication tools. Influencers add not financial advice disclaimers and claim they're just sharing opinions. The implication is clear. This is a problem of individual gullibility, not systemic design. Sounds reasonable, right? But if that's true, then explain this. Why does the North American Securities Administrators Association estimate that microcap fraud costs investors approximately $2 billion annually in the United States alone? Why do these schemes successfully target not just unsophisticated investors, but doctors, lawyers, and financial professionals? Why have pump and dumps not only survived decades of regulation, but actually proliferated in the social media age? And why do the vast majority of perpetrators never face criminal prosecution? Let me show you what's actually happening behind the official story. Here's what the art of the pump and dump actually is. It's an industrial-scale wealth extraction mechanism that exploits information asymmetry, psychological manipulation, and regulatory arbitrage to systematically transfer money from retail investors to coordinated groups of operators. This isn't a bug in the system, it's the primary feature for those designing it. The brilliance is that it makes victims blame themselves for outcomes that were mathematically guaranteed from the start, while actual perpetrators hide behind legal complexity, jurisdictional gaps, and transaction volume that makes enforcement practically impossible. The real mechanism works through 5 coordinated phases. Coordinated operators quietly accumulate large positions in low liquidity assets at basement prices. These might be penny stocks with minimal operations, obscure cryptocurrencies, or purely speculative tokens. Because trading volume is minimal, they can build substantial positions without moving prices significantly. Once operators control sufficient supply, they begin artificial price manipulation through wash trading and selling among themselves to create the appearance of organic demand and trigger algorithmic trading systems that detect momentum. Sophisticated promotional campaigns deploy across multiple channels, social media influencers, email newsletters, paid promotion websites, coordinated message board activity, and increasingly cryptocurrency and NFT communities. The promotion creates artificial buying pressure from retail investors who believe they're discovering an opportunity. As retail investors provide liquidity through their purchases, operators systematically sell their pre-accumulated shares at massive markups. They don't just sell at the peak, they distribute throughout the entire rise, taking profits at every level while new buyers continue arriving. When promotional campaigns end and buying pressure evaporates, prices collapse, leaving retail investors holding worthless assets while operators have extracted their gains and moved to the next target. Think of it like a factory production line, but instead of manufacturing products, it manufactures victims. The raw materials are low liquidity assets and psychologically vulnerable investors. The assembly process is the promotional campaign. The finished product is wealth transfer from many to few. Who profits? Let's follow the money trail. Primary beneficiaries include coordinated operator groups, promotional firms, social media influencers earning $10,000 to $500,000 per campaign, and the companies whose assets are being manipulated. According to a 2019 Journal of Financial Economics study analyzing over 175,000 stock promotion campaigns, operators earned average returns of 5.6% per day during promotional periods, while investors who bought during promotions lost an average of 14.5% within 30 days. This playbook has been refined for over a century. In the 1920s, before securities regulation existed, stock pools were so common they were barely considered fraudulent. Wealthy traders would pool money to manipulate radio stocks, the high-tech sector of that era. They'd bribe financial journalists to write glowing articles, the public would rush in, and pools would sell at inflated prices. This led directly to the Securities Act of 1933 and Securities Exchange Act of 1934. By the 1980s and 1990s, the boiler room era emerged. Firms like Stratton Oakmont, run by Jordan Belfort, perfected the modern pump and dump. According to SEC enforcement actions, Stratton Oakmont would underwrite IPOs of low-quality companies, control large stock blocks, use aggressive sales tactics to create artificial demand, and manipulate prices upward while restricting retail investors' ability to sell. By the time regulators shut it down in 1996, investors had lost an estimated $200 million, while Stratton principals pocketed millions. Notice what stayed consistent across different eras. The fundamental mechanism of accumulation, promotion, and distribution never changed. What evolved was promotional technology and legal camouflage. In the 2000s, pump and dumps migrated to email spam campaigns. A 2008 Journal of Financial and Quantitative Analysis study found that stock spam emails generated average returns of 5.79% for operators, while subsequent purchasers lost an average of 8.75%. Today's version is more sophisticated because promotional infrastructure has become democratized and deniable. Instead of obvious boiler rooms, operators use networks of social media influencers who claim they're sharing opinions. Instead of cold calls, they use targeting algorithms to identify susceptible investors. Instead of obvious penny stocks, they've expanded to cryptocurrency, NFTs, and legitimate seeming companies with manipulated prices. Here's where it gets darker. The psychology isn't accidental. It's engineered to exploit documented cognitive biases that behavioral economists have spent decades studying. Operators weaponize social proof bias. When you see thousands of people discussing an asset and posting gains, your brain interprets this as validation. A 2017 review of financial studies analysis found that stocks mentioned positively on social media experienced abnormal 2.3% returns on mentioned days, followed by reversals within 1 week. They manufacture social proof through coordinated posting, bot accounts, and paid influencers who disguise their compensation. They exploit authority bias through perceived credibility, YouTube channels with hundreds of thousands of subscribers, traders posting luxury lifestyle photos, accounts with previous winning calls. Behavioral finance research shows that when information comes from perceived authority figures, people spend 60% less time evaluating content and are 3.5 times more likely to act without independent verification. The emotional journey is carefully scripted: hope, excitement, commitment, doubt, shame, silence. It starts with hope. This is my chance to finally catch something early, moves to excitement to immunity vibe, rapid price increases, progresses to commitment, more money, telling friend, encounters doubt, first red candles met with diamond hands messaging, culminates in shame, realizing you bought the top, and ends in silence, not warning others due to embarrassment. Every stage serves the system. Your hope fuels the pump. Your shame protects perpetrators. When did you last see viral threads of people admitting I got dumped on by this influencer's call? Rarely, because they've turned your loss into private humiliation instead of public case study. They engineer social isolation by making you think you're the only one struggling. Platforms show winners, not losers. Influencers post 10x screenshots, not rugged positions. Forums exhibit massive survivorship bias. When you lose, you think everyone else made money, that you're just bad with money, that you should stay quiet to avoid looking foolish. This isolation is part of the business model. If everyone who got wrecked compared notes publicly, pattern recognition would spread rapidly. When you can see the blueprint, the extraction mechanism breaks down. Let's examine specific documented examples with verifiable money trails. The SEC charged 8 social media influencers running a Discord group called Atlas Trading. According to court documents, V. Constantinescu et al., they would buy stocks, tell hundreds of thousands of followers to buy them while claiming they were holding long-term, then secretly sell into the demand they created. Text messages released in the indictment showed them openly mocking followers, calling them bag holders, and joking about robbing idiots. They extracted approximately $100 million in illicit profits, while their followers absorbed the losses. Marketed as a charity token and endorsed by FaZe Clan esports organization members, this appeared to be a legitimate charitable initiative. However, blockchain analysis revealed that before public launch, insiders modified smart contract code to allow immediate selling, contradicting their public promises. The moment fans bought in, insiders dumped their holdings. The token plummeted over 90%, while the charity aspect served as a Trojan horse for wealth extraction. The late antivirus creator was charged by DOJ and SEC for classic scalping operations. Documents show he would buy obscure cryptocurrencies, tweet about them to his million followers, calling them coin of the week, then sell minutes later as prices spiked from his influence. The DOJ alleged he made over $23 million from this systematic manipulation, literally putting a price tag on his social media influence. These cases represent documented wealth transfers from retail investors to coordinated operators, with clear evidence of intentional deception and systematic extraction. The aggregate scale is staggering. According to Chainalysis, in 2022 alone, buyers spent $4.6 billion on cryptocurrency tokens suspected of being pump and dump schemes. The North American Securities Administrators Association estimates microcap fraud costs U.S. investors approximately $2 billion annually in traditional securities markets. Let's break down the mathematical reality of a typical pump and dump to understand the extraction mechanism. Accumulate 1 million shares at 10 cents per share, CUGS $100,000. Promotional campaign costs $50,000. Total operator investment goes at $150,000. Promotion drives price from 10 cents to 50 cents. Operators sell throughout rise at average 40 cents per share. Gross proceeds, $400,000, 1 million shares, 40 cents. Text operator profit, $1, $400,000, $150,000, $250,000. 200 retail investors buy average 5,000 shares each at 40 cents. Collective retail investment, $400,000. When promotion ends, price collapses to 15 cents. Retail position value, $150,000. Collective retail loss, $250,000. Text retail loss starts 40 cents, 15 cents, times $1 million, $250,000. Notice the mathematical necessity. Operator profits exactly equal victim losses. Pump and dumps are zero-sum games where wealth transfers from many small investors to coordinated few. Conservatively estimating 2,000 such schemes annually across all markets. Dartext annual extraction 250,000 times 2,000 cars 500 bill. This represents $500 million annually transferred from retail investors to systematic operators, and this conservative estimate excludes larger schemes and international markets. If this pattern is so obvious and documented, why doesn't it get stopped? Because the system has built an immunity through multiple protection mechanisms. The Sex Enforcement Division has approximately 1,300 staff monitoring over 27,000 registered entities and millions of market participants. They receive roughly 30,000 tips annually, but can only investigate about 1,000 cases. The mathematical reality enforcement capacity covers less than 5% of potential violations, making prosecution probability minimal. More insidiously, regulatory capture operates through revolving doors. According to the Project on Government Oversight, approximately 50% of senior SEC enforcement attorneys leave within 5 years to join private law firms representing entities they previously investigated. This creates perverse incentives where aggressive enforcement against major players can harm future career prospects. The securities industry spent over $450 million on federal campaign contributions in the 2022 election cycle, according to OpenSecrets.org. Both parties benefit from these contributions, creating bipartisan resistance to meaningful reform. When enforcement actions do occur, civil penalties average $175,000, while schemes generate approximately $800,000 in profits, making fines merely a cost of doing business. Stock promotion is legal with disclosure, but disclosure requirements are minimal and rarely enforced. Social media influencers can promote assets with simple ad hashtags that are easily overlooked. The legal standard requiring proof of intent to defraud is extremely difficult to meet in court, allowing operators to claim they genuinely believed in opportunities or were just sharing opinions. Exchanges, trading platforms, and social media companies profit from volume and engagement regardless of legitimacy. They earn fees from increased trading activity and advertising revenue from financial content. There's a multi-billion-dollar infrastructure that requires this churn to continue. There are casino owners who profit whether games are fair or rigged. Now that you understand the blueprint, you can recognize it everywhere and protect yourself while helping disrupt the system. Look for these red flags that indicate engineered manipulation. Heavy marketing across multiple channels for companies with minimal revenue or questionable business models. Any promotion emphasizing act now, limited time, or moving fast is exploiting FOMO psychology. Promises that sound impressive but can't be independently verified. Promoters who don't clearly disclose payment, relationships, or their own positions. Assets with small public floats, wild price swings on minimal volume, and irregular trading patterns. Awareness itself disrupts their business model. When enough investors recognize these patterns, the psychological manipulation becomes less effective, reducing the supply of uninformed victims that operators depend on. Historical precedent shows that regulatory reform occurs when public awareness creates political pressure. The Securities Acts of 1933-1934 followed the 1929 crash exposure of manipulation. Sarbanes-Oxley followed Enron and WorldCom scandals. Current pressure points include increasing data analysis sophistication that identifies manipulation patterns in real time, blockchain technology creating permanent, transparent promotional compensation records, independent research communities exposing schemes before full execution. Organizations like Hindenburg Research demonstrating how public exposure forces regulatory action. While working towards systemic change, protect yourself through never investing based solely on promotional content. If your first exposure comes through social media or marketing, treat it as requiring extensive independent verification. Verifying everything through primary sources, SEC filings, financial statements, management track records, being especially skeptical of investments requiring urgency. Legitimate opportunities don't disappear if you research them. Never risking more than you can afford to lose in speculative positions. Building community with people who share losses, not just wins, to combat the shame and isolation that protects scammers. The pump and dump is just one tentacle of broader extraction mechanisms that share the same blueprint. Create information asymmetry, exploit psychological vulnerabilities, extract wealth from many to few, and normalize losses as personal responsibility rather than systematic fraud. The same pattern appears in initial coin offerings that raise millions through hype and deliver nothing, NFT projects that generate artificial scarcity before disappearing, options trading strategies promoted by influencers who profit from selling courses rather than the strategies themselves, and countless other schemes that manufacture complexity to obscure simple wealth transfer. You're no longer a mark, you're an informed observer who can help others recognize what you now see. Every time you identify a pump and dump in progress and warn someone, you're disrupting the system. Every time you share this understanding, you're reducing the pool of potential victims. Every time you refuse to participate in obvious manipulation, you're making schemes slightly less profitable. The operators rely on your isolation, shame, and silence. Your awareness, willingness to speak publicly about these patterns, and refusal to blame yourself for systematic fraud. These are the tools that gradually make pump and dumps less viable as wealth extraction mechanisms. Systems designed by humans can be redesigned by humans. The first step is always the same. Enough people must stop playing the game on the designer's terms and start exposing how it really works. Pattern recognition is power. Use it.